500, and they would rather invest in Facebook's future competitor as a pre-IPO. For the same reason, people don't want to invest in Bitcoin, and they want to invest in these competitors that have a very low probability of success. They're basically buying up lottery tickets, and we all know that's not a very profitable way to make a living, going to buy lottery tickets, but that's what you're doing in crypto. If you want a safe investment in crypto, go buy Bitcoin. Don't put all of your money in Bitcoin. If you want to do it in a tax-deferred way, I hate saying it, but GBTC is your only option. You can buy that in your retirement fund. And you're right, I self-direct my own 401k. I'm responsible for my own retirement money. And you can do that. You can go buy GBTC. Hopefully there'll be a better ETF on the market soon, better than GBTC. And then you can buy it as a tax-deferred retirement account and, diversify your portfolio a little bit.
Right, let's talk about Bitcoin for a second. So you follow technical analysis, and you're known as somebody who teaches groups how to do technical analysis. And technical analysis is really the other side of the analysis portfolio one on Wall Street uses, the other being fundamental analysis, where you're looking at the actual earnings of a specific company and determining their growth rate. Technical analysis, you're just looking at the price charts and you're making certain assumptions about how prices tend to repeat and patterns repeat because they're subject to human emotions, and human emotions never change.
Exactly.
So people get greedy at the top, they get bearish on the bottom. When I was working on Wall Street, you have many what are called contrarian indicators. People tend to buy puts at the bottom. So the put-call ratio is bullish because it's a contrarian indicator. Yeah. Now, these are all very useful tools, and crypto space is a very young space. This tends to be, technological. I was resisting saying geeks and nerds and dweebs, but I mean, that's what we're talking about. This is all very new to them. How has that message been interpreted, accepted?
That's actually been great for me because I recognized pretty early when I started writing in the space about price and technical analysis that I really am dealing with a lot of people that are getting into trading because of this the removal of barrier to entry to become a trader and a speculator on all of these assets without any kind of learning. It's almost like, hey, you know what? Let me go drive in the Indy 500 before I got my permit and driving a car. And I kind of carved out this little niche where I have experience in trading. I have watched the markets for 15 years. I've worked on Wall Street for 10 years. Lots of trading experience. And hey, let me at least educate people on how to be traders. It doesn't mean they're going to make money trading, but at least they'll have an idea of the other side of trading, which is technical analysis and using charts and using those emotions and putting yourself in better probabilistic bets to potentially profit from the market. The problem that we have is people can't separate, because they're too young of investors, they can't separate the idea of an investor from a trader. A trader should never be married to the asset that they're trading. It's just something. So if you are in love with Bitcoin or you're in love with Ethereum, you're not going to be a very good trader of those assets because you're emotionally involved. The best traders are never emotionally involved with the assets that they're trading. And
right, there's two sides to this. One is making money. The other one is risk management. So technical analysis can be a tool for speculation, but it's also a tool for risk management as far as where to put in stops and other orders to keep your money from being drawn down. I mean, this is what the trader, once you draw down money, you have the arithmetics of losing. It takes more money to get even than the amount of money that you drew down. So if you drew down 10%, you got to make more than 10% to get back to even. So this is the cycle that people get into, and it's very destructive. And I want to talk about something, a 51% attack. When Satoshi Nakamoto envisioned Bitcoin, he talked about the 51% attack. And we know that it's been resistant to a 51% attack. He did not mention futures in the white paper, or any of the correspondence he had with anyone that I'm aware of did he mention financial futures. We do now have Bitcoin futures. And the argument against the 51% attack put forward by Satoshi is that, according to game theory, you wouldn't do it because you'd wipe yourself out. But if you took a position in the futures market and then you attack Bitcoin, say you took bought a put on Bitcoin, and then you killed it with a 51% attack, there's some room to manipulate or to make markets or to trade. Your thoughts?
I think that would be very, very difficult because the futures have just come online and the volume on those futures is pretty low. The leverage on those futures is also pretty low. But the Bitcoin hash rate and the ability to get that 51% is very, very high. And by the time futures could be liquid enough to profit well from this kind of idea, the hash rate is going to be exponentially higher still, making it so hard to do the 51%.
So it gets back to Bitcoin is running ahead of the devil. Yeah. It has since day one step
Correct.
Ahead of the devil.
In addition, it would be a very dangerous bet because as the Bitcoin market grows higher, who's going to be the counterparty? Yeah, you're going to take on all of these short plays. Like, remember what happened in the financial crisis, right? Everyone thought they were going to make so much money off of the proper position on the CDOs, except the counterparties also failed.
No liquidity.
Right, no liquidity, right? So just because you made this giant bet, and you were absolutely right, what happens when your counterparty was too leveraged and the counterparty goes down?
Well, there's an old saying called you have to feed the ducks when they're quacking.
Right.
Have you heard this one?
Yes. And the intermediary, the CME, has insurance to back this up, but they could also not have enough. This is what the CEO of Interactive Brokers was very, very worried about. But on the upside, not on the downside, that there may not be enough backup and liquidity to do it. So it's difficult. And I always say a lot of people, there are gold bugs, a lot of people that want this catastrophe to come, but you don't realize if the catastrophe is too big, nobody wins.
John Vays, thanks for being on the Keiser Report.
Thank you.
That's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacey Herbert. I'd like to thank our guest, John Vays. If you want to catch us on Twitter, it's Keiser Report. Until next time.